and welcome to this special conversation in association with Mahindra Manulife Mutual Fund and Moneycontrol. I'm Sumera Abdi, and today we want to explore a little bit about the active-passive landscape in India. What are the current trends? Where is it headed? What does it mean for investors? What does it mean for your portfolios? The nuances of investing in both kind of products, which are the kind of categories that are doing well. So all of that is what we're going to be discussing today. And joining me to talk about this are two experts, Mr. Ashutosh Bishnoi, MD and CEO of Mahindra Manulife, and Mr. Krishna Sangvi, the Chief Investment Officer of Equity at Mahindra Manulife. Gentlemen, thank you very much for being a part of this. Mr. Bishnoi, my first question is to you. We're seeing that incrementally every month, passive products are seeing, if not more, then at least they are keeping step with the inflows that we're seeing into active funds. Do you notice or do you feel that investors are now a lot more accepting of passive products?
Thank you, Sumaira, and thanks for having us. So when it comes to the active and passive debate, it's a worldwide debate that's been going on for a very long time, since the time that Vanguard first started its business in America. Now, looking at India, the scenario needs to be looked at a little bit differently, according to me. What happens here, what you're seeing now, is ETFs and passive funds, which ETFs are also passive because they're built around some index or the other. These are funds that are being brought to market by managers who have a full basket of active funds in any case. So unlike in the other parts of the world where managers or fund houses differentiate themselves by being active or passive, in India, I suspect this is happening because if you've already got every conceivable type of active fund, what new product are you going to get to market? So people are looking at active. So that is certainly part of the process is driving it. Whereas in the terms of market maturity, when passives become relevant is only when market participation of active managers is so high that producing alpha becomes near impossible. So, for example, in the United States, in the late 80s and early 90s, active managers controlled more than 50% of the market cap of the equity market. At which point in time, well, you become the market, right? And for you to be able to differentiate and come out with alpha is extremely difficult. And that's when the passive products do well, because people don't see sense in paying for somewhere between 2 to 5% as fee when they need not pay and they can get the market returns. In India, we are very far away from that. What we are really seeing today is passive investment is largely contribute or taken up by the subscription to passive funds. If you analyze the data, you will find, I would imagine 80 to 90% of the subscription comes from institutional players, such as the Employee Provident Fund organization, who would rather play the market as a whole than put its bet behind any one manager. So as institutions such as provident funds and pension funds get permitted to participate in equity markets, they prefer to go the passive way, because then there is no process to actually select a manager or take a risk on a management style. They have the equity exposure, and generally speaking, in India, indices do reasonably well. I mean, if you look at Nifty from its inception, its return is 12% on the growth and about 1.5% on dividend. So for a pension fund in India, which typically gives its customer a return of 8 or 9%, that's like very good news, isn't it? You're getting 12.5 or 13.5%, not have to select a manager, do nothing, very low cost. So I suspect they are the ones who are driving the demand at this point in time. Will it go to the retail in a significant way? I have no doubt it will, because the smart investors, the large investors, even in the what you call the high net worth area, recognize that they are pretty good, very smart with the managing their own money, and they don't need to pay somebody 2.5, 3% to get their money managed. They'd rather pay the 0.5% on the passive and use the market as a foil for their other investments. But for it to become a very popular retail, crores of investors kind of uh, product, I think it will take a little bit of more market maturity for that to happen.
No, I take your point, Mr. Bishnoi, entirely that somebody may not be keen to pay the management fees or, the wealth advisory fees, whatever you may call it. But when you play the market, you also, sort of catch the entire risk of the market, which in an active fund, to some extent, perhaps your fund manager may be better at managing. So, therefore, Mr. Sangvi, let me come to you. For 2020, we had seen the Dow Jones PIVA scorecard for India was pretty damning. A very large majority of active funds could not beat the benchmark. Is it becoming more difficult to create alpha in a market or an economy like India? And what is the outlook?
I think alpha generation by a fund manager through active processes, actually we need to look at it in a slightly different context, which is the economy. I mean, let's not forget the basic fact that it's an economy which grows, that enables the corporates to do well. Some corporates do far better than the economy, and some falter the economy. That's part of business cycle, parts of which sector does well. So to an extent, the entire debate about active and passive, and yeah, there are enough examples everywhere. But I would like to place a slightly different context that yes, there is an active, there is a passive, uh, and the relevance of active versus passive actually plays out over a cycle of economic growth. I mean, let's look at a journey of a company. It becomes just comes out of infancy, does its business, moves from a maybe small cap to mid cap to large cap. Some stage it may end up in a bigger indices. That's, let's say, journey of a company. Look at journey of a country. Every economy goes through a cycle of low growth, high growth, medium growth. Growth phases differs based on the underlying geographical resources, etc., which company has, or the inherent strengths of the economy. So one way to interpret this entire active versus passive debate is at what stage of economic cycle that particular economy is, that particular growth phase is. So if I look at it this way, and I'm using a number can be off by a percentage here and there. But if you really look at maybe last 15, 20, 25 years of evolution of passive, well, perhaps in 1980s it was almost a nil kind of AUM versus what it is today. I think if you follow the world economy, US economy specifically, where ETF is more popular, perhaps into my mind there's a number called 5%, 6% nominal growth. It includes the real and inflation both. I think somewhere that the tipping point comes for an economy, because let's accept that finally the GDP growth of country is what is represented by the corporates, in the sense that that populates down to corporates. So on a very macro picture, if economy does 5-6%, the best corporates can maximum do 10% kind of growth is a basic theory. Now look at Indian context right now. We are still in some sort of a double-digit nominal GDP growth rate. Vis-a-vis maybe we know what the Western world, especially let's say US, is going through for last 5-10 years. So my sense is we need to integrate this debate about alpha generation, about active versus passive, looking at the economy. When economy is growing, 10 people grows, 20 people grows, and the list keeps on increasing, because let's understand, in a growth economy, everybody is a consumer and everybody is a service provider. So either moment I earn more, I will get my own spending power in place, and somebody else will earn from me. So that challenge of a growing economy, and that's where you see maybe as again economic theory says, a lot of these things are perhaps linked to the demography of our country. What's happened to maybe Japan as a market, as an index, versus what's likely to happen to India can be very different, because our demography is in our favor. So I will say the entire debate is about the growth phase of the economy. Yes, there may be some time in future. I really don't know how quick or how late it can be. But yeah, we may also reach a situation where our nominal growth rate starts dipping more towards that, that expected 5 or 6% kind of number, where it might be difficult for companies to really grow significantly ahead of each other. Another way to look at the same debate is, that when the economic growth is low, there is a big fight for market share because everybody wants to grow, and that's where, typically the margin pressure starts hitting the companies and the corporate profitability is hit. But in a pure growth economy, that's less of a pressure to eat into each other's market share and, not so worries on the profits. So I believe that at juncture at which we are, I mean, let's not forget today, India, all said and done, despite whatever we read all around, we are still the seventh largest economy in the world. And by a fair estimate, we are on track to become third largest in next 5, 7, 8 years. That 5, 7, 8 years is a more a question of, growth path rather than, destination not being met. So if I look at it that perspective, or third, I mean, seventh economy in the world likely to be third, there's enough growth opportunity. I possibly worry as a pure from coming speaking as a fund manager. I'll worry more of it as and when one actually gets into a stage where India really, moves into that higher growth phase in both relative terms, in terms of percentage, and even absolute size of the economy matters. So that's how I'll possibly say this entire debate about active and passive.
Yeah, and not to mention the fact that mutual fund penetration in India is what as a percentage of GDP just 16% right now, which compares to 145% for the US, 103% for Canada, 192% for Australia. So definitely, the scope exists in India, I guess, for both active and passive. But Mr. Bishnoi, I wanted to ask you this, that, one of the best investors in the world, Warren Buffett, I think in one of his annual addresses in the Berkshire conference had said that 90% of the money that he would leave for his wife, he has put it in an ETF. Now, how do suppose that one of the best investors in the world, who's known for his, stock selection, would prefer an ETF? And how do you contextualize it for an Indian investor? Because in India itself, we're seeing pockets of stress, within the mutual fund industry. And while they may be limited, in scope, but the impact on sentiment has been quite large. So, do you suppose that Indian investors may also soon start believing that perhaps an ETF or an index fund or something like that would be perhaps lesser stress?
Sure. No, I think you hit the nail on the head when your last sentence. So I'd love to know, of course, which ETF Mr. Buffett is going to use. Uh,
I think
so I,
he's chosen one of those Vanguard
Mm.
index funds.
Yeah, so I suspect there'll be many of them. So you have to understand from the role that ETFs and passive play in the US economy is exactly that. That possibly Mr. Buffett believes that his wife is not necessarily as smart an investor that he is, or may not have the time to look at investing. And that is exactly the kind of people for whom passive products in the US do well. And they do well because, and I'm not surprised he said ETF and not an index fund, because you have to understand the ETF domain in the US includes a very large portion today. In fact, if I'm not wrong, the market cap of actively managed ETFs is larger than passive ETFs. So it's quite possible that he may be referring to one of those. It's a new hybrid animal that emerged in the US, I think, about 5, 7 years ago, and has taken people by it's taken the fancy of people because it has the advantage of adhering to an index, but it needs a manager's oversight to keep rebalancing and correcting. But not surprising, it is passive is meant for people who just don't want to even want to understand what's under the bonnet, right? They don't want to know how the car drives. They just want to press the start button, press the accelerator, and go. So passive products were created for people like those. And in the US, because the return profile between active and passive was so narrow for a very long period of time that you it was a difference of maybe 100 basis point or less at some point in time. So therefore, it made sense for people who didn't want to know what goes inside to put their money in an ETF, and that's classically how probably Mr. Buffett referred to it. It is meant for, I hate to use this term because it seems to have gender issues with it, but people who look after homes and not look after uh, job careers, probably they are the ones for whom ETFs will do well. I don't want to make it a gender issue because I think that's wrong to do. But it's meant for people who can't be bothered beyond a point, and they want to participate in some part of the market. They understand enough to say, okay, I see banks doing well around me, so I'm happy to put my money in a banking ETF. But they don't want to really know which bank and how and which one will do better, etc. So it will come to India. I have no doubt about that. That that level of popularity will happen in India. Exactly, starting in those customer types who don't have the time, couldn't be bothered, and just want to put their money, knowing that it's in the stock market and it will give a decent return. In fact, that exactly today, if it was possible to popularize an ETF or a passive product, it's a perfect market in India, isn't it? I mean, you're getting, which market in the world gives you 13.13.5% on an annual basis by doing nothing, just put it in the market, right? And should be a perfect ideal situation for a passive product, but it isn't because there aren't enough takers for this. There aren't enough people who can market this profitably. So that actually is the other side of the story. That active products carry with them a reasonable remuneration for those who manage the active industry. The passive products in India are not able to reward the industry at all, and therefore would have very little room for popularizing, developing that market. Why would somebody do that? If all that I have to do is to take you to buy the Nifty, well, I'll say do it yourself because there's nothing in it for me. So, to make it interesting for managers to take this product forward, there has to be a large enough franchise. Another business side of the problem is, and maybe Krishna can speak about this a little more, but you see, we are a very shallow market. If I think of a business to set up today, it's a huge leap of faith that this market will develop depth sometime soon. When I say depth, you run out of stocks to invest in. And I'm not a manager, Krishna is, but after 200, you struggle. So, how many indices will you create in 200 stocks? Maybe, 4, 5, maybe 10. But then what? The US industry of ETFs and passives runs into thousands and thousands of indices and stocks because there is such a lot of depth. And you can successfully create an ETF and run it. You will not run into liquidity issues or tracking error because you could not invest. Now, if you take the price of each Nifty stock and add it up, I would imagine it will total up to close to some 7, 8 lakhs of rupees. Which means that if I don't get 7 lakhs of rupees per ticket, I can't invest the money. Because I can't buy the index for that person who gave me that money. Somebody gives me 50,000, I have to wait for the next 7 guys who give me 50 or 10 guys who give me 50,000. So which means tracking error develops. So these are some of the practical challenges of managing passives in India. And therefore, we must get more interest. We must get deeper market. And there must be something in it for the people who manage the industry. And that something will come out of technological advancement. To be able to make money at 50 basis point gross margin means you really can't employ people to do this much.
Yeah.
Because
No, absolutely. Look, it's
so
like a vicious cycle, right?
somebody will break the cycle. I'm saying that we probably will reach that point sometime in the next few years. I hope it is sooner because it is a good thing for the market. While we are active managers, I believe it's a good thing for us if more people invest their money in mutual funds, irrespective of whether it's active or passive, because that's when you need the 16% of GDP to grow to 160%, right? That's when you really have a truly large, well, well working industry contributing capital to the economy, right?
Yeah, so move the household savings to a great extent from what is currently, I think, gold and FD
Yep.
to financial products like mutual funds. But you know what? How it goes? The investor says, "Give me more depth, give me more choice," and you say, "Give me more investors so that I can provide you with exactly that." So you know, I know where the shoe pinches, perhaps for each party involved. But Mr. Sangvi, therefore, do you think in India, at least for a long time to come, it will be more like active plus passive within the portfolio as opposed to either active or passive?
No, clearly, I think in the Indian context, one can actually look at passive in a different way. I mean, vis-a-vis the Western world. Look at the penetration of mutual fund investors in India, as we all agree and understand it's a bit low. Actually, investors can really take passive as an entry strategy, if at all. They really don't, want to get into alpha generation mode, but be happy with the pure index return. And as they understand the markets better, that's the time they can actually move into active. I know what I'm saying is actually a reverse of how the global markets have developed for ETF. But as you know, Ashutosh also nicely mentioned that a lot of financial innovations in the world, have got compressed into India in very short time. So if you look from a typical investor risk profile, let him get used to equity first. Let him get used to whatever index he has in mind, maybe Nifty, maybe Sensex, maybe something else. And then after understanding the ups and downs of markets as reflected in his, in his NAVs or his portfolio values, that's the time he is ready to get into active where he can actually realize, okay, if my fund manager does better, I can actually do 1, 2, 3, 5, whatever percentage more than the index, or at times I may do inferior than the index. I think that's the journey maybe of a financial literacy side where a passive can actually be an entry strategy. I mean, I really don't know the background. Maybe it might just be a thought process I'm sharing. But let's look at what has happened to entire pension fund industry in India. Till 5 years back, India 7 years back, pension fund was pure play debt markets, which was significant into GSECs and little bit into corporate debts. It's only in last 5 years or so the government actually opened up the sector to equity markets, and they said, okay, investors can invest into equity. And if I use this example, as how a journey of 100% debt investor, whether it's an institution or retail, does not matter. They started with the easy concept of, okay, let me get my basic understanding of markets, or betting my fit with pure play passive where I earn exactly same as index. I do not really worry about alpha to the start with. Let me understand better, and moment that part is in place, that same investor can actually aspire to get into a alpha or an active fund management. As I'm repeating, maybe the active fund management little bit has got a role with the size and scale of economy and the growth. I think that part, if we integrate, so you can actually look at it as a passive investor. Entering equity itself is a very active decision for the person, but somebody who's actually into a fixed deposit or a PPF or a maybe post deposits, etc., etc. For them, getting into equity market itself is a decision to move from passive to active, where the value of his investments can technically change every day, which is very unlike a fixed deposit instrument. So once he or she gets used to this, maybe after some time, 6 months, 12 months, 5 year, choice is investors, obviously. But yeah, that's the time they can actually migrate from passive to active. And I really see an opportunity on that front also. Obviously, all these opportunities are a function of finally the growth. So as long as India as a country, we grow, we prosper, this there is enough opportunities for more and more companies to grow significantly faster than the index, and that creates value. Beauty of it is that in a passive strategy, finally somebody 3, 5, 10 member committee ends up choosing the so-called 30, 50, 100 stocks in an index. But the economy, the free market economy, doesn't worry about those 100. They worry perhaps about those companies which are in the best position to serve the customer, make money by way of getting the right products, right services in place. So finally, from a capital market perspective, I think economy will produce those winners, and it's for an active fund manager to try and choose. Yeah, there may be those times you may have a 6 month, 12 month aberration wherein those debates can come up about active versus passive, who's doing better, etc. But those are the phases of economic cycle which we understand. That's my way of putting the entire debate. Look at the maturity of the investor. He's just migrating from a guaranteed FD kind of world to a equity. Let him start with passive through maybe ETF, maybe index fund, and then migrate to active rather than worrying about active people actually turning passive so early in the economic cycle of the country at which we are. Yeah, we will reach some
Yeah.
stage, but that's future.
Fair enough. So, Mr. Sangvi, you've just launched your Flexi Cap NFO. Uh, and I'm just curious. I mean, since you're talking about this whole scope for active management in India, there are already any number of Flexi Cap funds now, which have already converted to this category. We have recently seen, highly successful NFO from another AMC as well. Does this suggest that you see, a greater role for the fund manager in India's context? Because FlexiCap, by its very nature, is now the only remaining, mutual fund category where the fund manager has the most to contribute, right? Their conviction call plays out in a FlexiCap category. What is your rationale?
No, I agree fully. You captured it well. A flexi fund as a category really captures a wide spectrum of market, allows the fund manager the real flexibility to move into large cap, mid cap, small cap of his choice. There's always this active management which comes in on two counts. One is the stock selection, which is clearly nothing to do with large cap, mid cap, small cap. As I mentioned, there are companies which grow, and when they grow, they don't really have a constraint of large, mid, and small. So that's a pure bottom up stock selection which comes in. Kind of industry they are in, the kind of management quality they have, the kind of growth opportunities available. I think those will decide which companies look attractive at a point of time. Obviously, there is a variable called valuations, and that's where integrating this valuation into a portfolio approach of large cap, mid cap, small cap can be adopted. You like a lot of companies at various points of time, but maybe the valuation cycle of the company, or maybe the underlying market cycle of maybe euphoria, or maybe extreme pessimism on large cap, mid cap, small cap, can be nicely built in, where the portfolio construction is based on some sort of weights which comes in, while the stock selection is clearly a bottom up. I mean, let's look at it today. Today maybe there's this enough discussion about maybe euphoria in small cap, but exactly a year back, had we met a year back, they were exactly reverse, right? And markets being markets, economies change, regulatory policies change, financial conditions change, and leadership changes from large cap to mid cap to small cap. And that's what I believe this particular category of flexi uh, fund mandate, which as there is no constraints attached or no minimum directed investment in a particular category, offers a great potential for a fund manager who's able to take those right investment decisions on both stock selection and the portfolio construction using those variables.
Okay. So that's the rationale why you're looking at launching this, flexi cap scheme, and by the way, all the very best to you, Mr. Bishnoi. Just one last question on, to sort of wrap up this debate is, what is the scope for innovation now? Active is pretty saturated already, right? I mean, the regulator blessed us with the flexi cap category, but that was out of the blue. Now the real scope for innovation, I mean, to my mind, appears only in the passive space. We're seeing some smart beta, products being launched, etc. Where do things go from here?
Yeah, you are right. There is a lot of, you could easily think like that there is saturation. Let's remember we are really a small market, and saturation is not something I like to think of a market as. even flexi cap fund, which is today I think the single largest equity category in India. If I'm not wrong, about a lakh and 70,000 crores is being managed in assets. Um, I don't think saturation will be reached until it is like, by itself as a category worth 30 lakh crore. But quite
No,
besides that,
saturation I meant in the number of
what are
schemes or
the
the
ideas?
types of schemes.
Yeah, so there is one particular area which beyond besides passive or active, if you cut it on a different dimension, and I believe that Indians as investors have a very large and sometimes unhealthy home bias. Let me explain what that means. We invest money in equities in India and India alone for no other reason that we like to invest here. Now, the reason that we don't invest anywhere else in the world is probably because we don't have information, nobody markets to us. But the fact remains that there are markets in the world that consistently outperform India, typically when India underperforms. And there is no reason why mutual funds, who've had this mandate to play this role for a very long time, actually, that you can create fund of funds and invest people's money outside India, haven't done that. But you see now a beginning on this direction being done by a few fund houses. And I'm very happy to see that they are actually gathering a lot of interest, because I believe that it's simply it's possible to create counter cycles in a client's portfolio, an investor's portfolio, by diversifying him away from only investing in the Indian equity markets. So, and it's not just that, I'm not just saying because, we are of course looking at it very aggressively, and we are going beyond equities in that into multi asset classes, because we believe that while equity as an asset class does offer a fairly substantial and a very efficient market in India, in other asset classes, for example, in fixed income, beyond, let's say, the government issued securities, the other markets probably are not as efficient as they are in the other parts of the world. So corporate bond market is still, liquidity becomes an issue after a point. If you go beyond AAA, the traded market is small. We still a lot of, there's not enough screen-based trading. So there are other issues. Real estate, for example, is completely has been absent until recently, right? We got maybe 4 or 5 listed REITs at this point in time, which has all happened in the last couple of years. So I believe that innovation will come from looking at multi-asset classes, not just in India but outside. And there are good managers across the world who've been doing this for a very long time, and it doesn't cost the investor more money to do this if it is done via the fund. As a matter of fact, there is a special dispensation beyond the RBI's LRS scheme, within which otherwise people would have to use the LRS permissible limit to invest outside India. But the mutual fund is allowed to go beyond that, right? There is a there is a specific, fairly large and substantial space defined by the regulators for funds to invest. And I would like to see a lot of work happen in that, because I believe that there are Indian investor types for whom asset classes outside India would be very meaningful. Real estate is an example. I mean, we always talk about how Indians as an investors are real estate obsessed. I mean, that practically forms 70 or 80% of anybody's portfolio, right? But playing that in a securities market has not been possible, and it's possible very easily, not just in United States, but don't go far. I mean, you can go to Singapore market, and it has a vibrant listed real estate and REITs market. So I think we need to think innovation from that perspective. We have to not think of investing abroad as something only available for very high net worth sophisticated investors. We have to think of it as finding a solution for small investors from those markets, and then we will find innovation happening. So whether it is passive or active is another dimension, but it could be even cross-border passive, for example. I mean, take for example, I mean, The largest gold ETF in the world is GLX on New York Stock Exchange, right? It is probably the single largest institutional owner of gold in the world. Why should Indians who have an obsession for gold not invest in that?
Yeah.
Why should we have to limit ourselves with all the challenges of trading of gold in India? Even in the ETF, right? We get There is taxes, there is a whole issue of accounting and custody, market making. So I think time has come to think beyond borders. Not we think beyond borders in everything else, right? In fashion, in food, in entertainment, in everything. But we are not thinking beyond borders in the most core product that we deal with, which is money. So I think time has come to do that.
No, absolutely. And I remember a time when I started out my show, and the advice that experts would give is that if you're planning to have a child go abroad to study sometime in the future, you may look at some investments to sort of hedge the currency. But now more and more people are saying that practically everybody needs some sort of international exposure. So, Mr. Sangvi, final question to you: is this international market then the new frontier?
No, clearly, uh, investors have to migrate to multi assets, right? I mean, what we discuss, large cap, mid cap, small cap, is nothing but a natural extension that there are other countries in the world which may, at various points of time, offer you a better opportunity. And to that extent, one has to look at global markets as an investment opportunity, uh, which is what financial markets all about are, in the sense that you look at what is this category called FPI, which we are, they own almost 24-25% of Indian listed equities. They are the people who actually scout around for investment ideas across the world. They invest in Germany, in US, maybe in Hong Kong, maybe in Australia. I mean, you name the country and geography, they are present. And the idea is simple, to look at an alternate opportunity which makes more financial sense from an investor perspective. So to an extent, that's something pretty much, and that's the trend. If I look at how all the emerging markets, or other all the markets in the world have moved, every investor starts in his own home country, gets that experience, gets understanding, and at some day decides to allocate maybe 1%, 5%, 10%, 20% money, whatever is the right number in his or her financial planning. That's the journey, and that gives you both the exposure to global economy, because we know economies are cyclical. When advanced economies do well, maybe emerging economies may or may not do exactly well. Something similar is going to play out. So from an investor perspective, yeah, we need that, some sort of, either you call it diversification, is from a risk management side, but from a returns optimization side, I'll call it better investment opportunity. We exactly know what's happening in the world, across geographies. There are people exceedingly doing far better than India. I mean, while I mentioned about those 5%, let's say, nominal GDP growth rate in US over a 10 or 15-year cycle, there are companies which are growing much faster in the same country. So it's never a question of uh, any individual company being restricted by the growth rate. So to that extent, yes, investment opportunity in international market is something one should definitely look at. As I mentioned, percentage is left to individual choices.
So let
All
me,
right.
if I may add a line there.
Yes.
It's as simple as this. India is one of the largest and the fastest growing market for so many multinational brands and companies, right? You think about what you spend your money today on as an Indian, and it's unlikely that you will not hit at least 8 or 10 really large global leading companies who are making profit selling the stuff to us. I think time has come for this consumer to profit from his expenditure, right? The company is making profit by selling to him. It's time for him to make profit by investing in their company. It's just as simple as that. And I think people will understand this if it's put it simply and nicely like this.
Mr. Bishnoi, Mr. Sangvi, thank you very much for your time today, and for putting across your thoughts on the whole active passive debate in India. And while in a growing economy like India, the scope exists for both active and passive, there is no denying the fact that passives are seeing some sort of a snowball effect, and perhaps a larger role in the time to come. But for now, both exist on the table for retail investors. So thank you very, very much for joining in. And for everybody who's watching this webinar, I hope you enjoyed it, and we look forward to hearing your comments and suggestions.